I highly recommend you to read the original book of the author. But here in this video, I've summed up my 10 takeaways and thoughts about this book so you may have a more weighted opinion about the book. Disclaimer: this video does not infringe on the copyrights of the author of the book, as this video is based on fair use doctrine and explains my own opinion about the book, and does not use any direct text from the book. Here are 10 main points from the book, Beyond Diversification, by Sebastien Page. 1. Diversification is not enough. While diversification is important, it is not enough to protect your investments from all types of risk. 2. There are different types of risks. Investors need to be aware of the different types of risks that can affect their investments, including market risk, inflation risk, and geopolitical risk. 3. Active management can help. Actively managing your portfolio can help you navigate market risks and take advantage of opportunities in the market. 4. Bonds are still important. Even in a low-interest rate environment, bonds can provide stability to a portfolio and protect against market downturns. 5. Consider alternative investments. Alternative investments, such as real estate, commodities, and hedge funds, can provide diversification benefits and help protect against market risks. 6. Behavioral biases can impact investment decisions. Investors need to be aware of their own biases and emotions when making investment decisions. 7. Focus on long-term goals. Investors should focus on their long-term investment goals rather than short-term market movements. 8. Be mindful of fees. High fees can eat into investment returns over time, so investors should be mindful of the fees they are paying for investment products. 9. Consider environmental, social, and governance (ESG) factors. ESG factors can impact investment returns, and investors should consider these factors when making investment decisions. 10. Stay informed. Staying informed about market and economic developments can help investors make informed decisions about their investments. The first point of the book, Beyond Diversification, by Sebastien Page, is that diversification is not enough to protect investments from all types of risk. While diversification can help investors reduce the risk of losing all their money in a single investment, it may not protect them from systemic risks that affect all investments at the same time. For example, during the 2008 financial crisis, many investments across different asset classes and sectors suffered significant losses. This is because the crisis affected the entire financial system, and diversification alone could not protect investors from this systemic risk. Therefore, the author suggests that investors should also consider other risk management strategies, such as hedging, active management, and alternative investments, in addition to diversification. By using multiple risk management strategies, investors can better protect their investments from different types of risks and potentially improve their long-term returns. I'd be happy to explain point 2 of the book, Beyond Diversification, by Sebastien Page. The second point of the book is that investors need to be aware of the different types of risks that can affect their investments, including market risk, inflation risk, and geopolitical risk. Market risk refers to the risk of losing money due to changes in the overall market or a specific sector. For example, if the stock market experiences a significant downturn, it could negatively affect the value of an investor's stock portfolio. Inflation risk refers to the risk of losing purchasing power due to inflation. If the inflation rate is higher than the return on an investment, the investor's real returns will be reduced. Geopolitical risk refers to the risk of economic and political events affecting investments. This can include things like wars, trade disputes, and natural disasters. For example, if a country's government changes policies that negatively impact a particular industry, the investments in that industry could suffer. By understanding and accounting for these different types of risks, investors can make more informed investment decisions and build portfolios that are better suited to their risk tolerance and investment goals. The third point of the book, Beyond Diversification, by Sebastien Page, is that active management can help investors navigate market risks and take advantage of opportunities in the market. Passive investing, such as investing in index funds, has become increasingly popular in recent years due to its low fees and broad market exposure. However, the author argues that active management can still play an important role in investment strategies. Active management involves selecting and managing investments with the goal of outperforming the market or a specific benchmark. While active management can involve higher fees, it can also provide investors with greater control over their investments and the ability to adjust their portfolios in response to changing market conditions. For example, during a market downturn, active managers may be able to reduce exposure to risky investments and focus on defensive sectors or assets, which can help to limit losses. Conversely, during a bull market, active managers may be able to identify undervalued assets that are poised to outperform the market. While active management is not without risks, the author suggests that it can be a valuable tool for investors who are willing to do their research, monitor their investments, and make informed decisions. By combining active management with other risk management strategies, investors may be able to build more resilient portfolios that can perform well in a variety of market conditions. The fourth point of the book, Beyond Diversification, by Sebastien Page, is that bonds are still important and can provide stability to a portfolio and protect against market downturns. Bonds are a type of fixed-income investment that pay investors regular interest payments and return the principal investment at maturity. While bonds generally offer lower returns than stocks, they are often considered less risky because they provide a fixed rate of return and are less volatile than stocks. In addition to their potential for stable returns, bonds can also provide diversification benefits when combined with stocks and other assets in a portfolio. During periods of market volatility or economic uncertainty, bonds can provide a cushion to a portfolio and help to reduce overall risk. Moreover, different types of bonds can provide varying levels of risk and return, which allows investors to tailor their bond investments to their risk tolerance and investment goals. For example, government bonds are generally considered less risky than corporate bonds, but they may offer lower returns. Overall, the author suggests that bonds can play an important role in a well-diversified investment portfolio, and investors should consider their potential benefits when building their portfolios. The fifth point of the book, Beyond Diversification, by Sebastien Page, is that investors should consider alternative investments to diversify their portfolios and potentially increase their returns. Alternative investments are a broad category of investments that are not traditional stocks, bonds, or cash. They can include things like real estate, commodities, private equity, hedge funds, and infrastructure. The author argues that alternative investments can provide unique benefits to investors, including low correlation with traditional investments, potential for higher returns, and exposure to different types of risk. For example, real estate investments can provide regular income streams and potential capital appreciation, while commodities can act as a hedge against inflation and currency fluctuations. Private equity and hedge funds can offer access to investments that are not publicly traded and may have less correlation to the stock market. However, alternative investments are often less liquid than traditional investments, which means they may be more difficult to buy and sell quickly. Additionally, they can involve higher fees and require more due diligence and research. Overall, the author suggests that investors should consider adding alternative investments to their portfolios in order to diversify their holdings and potentially improve their long-term returns. However, investors should be aware of the risks involved and carefully evaluate each investment opportunity. The sixth point of the book, Beyond Diversification, by Sebastien Page, is that investors should consider the impact of taxes on their investment returns and look for opportunities to minimize their tax liability. Taxes can have a significant impact on an investor's returns, and it is important for investors to understand the tax implications of their investment decisions. For example, capital gains taxes are typically assessed on the profits from the sale of an investment, and higher tax rates can significantly reduce an investor's returns. To minimize their tax liability, the author suggests that investors consider tax-efficient investment strategies, such as investing in tax-advantaged accounts like IRAs and 401(k)s, or investing in tax-efficient funds that aim to minimize the amount of taxes paid on investment gains. Additionally, investors can consider tax loss harvesting, which involves selling investments that have declined in value in order to offset gains from other investments and reduce their overall tax liability. By taking a proactive approach to taxes and incorporating tax-efficient strategies into their investment plans, investors may be able to improve their after-tax returns and keep more of their hard-earned money. The seventh point of the book, Beyond Diversification, by Sebastien Page, is that investors should focus on their investment goals and develop a personalized investment plan that aligns with their unique circumstances and risk tolerance. The author argues that investing is not a one-size-fits-all approach, and each investor should have a customized investment plan that takes into account their financial goals, time horizon, risk tolerance, and other personal factors. To create a personalized investment plan, the author suggests that investors start by identifying their long-term financial goals, such as saving for retirement, buying a home, or funding their children's education. Once these goals are established, investors can work with a financial advisor or use online tools to determine the appropriate asset allocation for their portfolio. The author also emphasizes the importance of regularly reviewing and adjusting an investment plan as circumstances change. For example, as an investor's time horizon or risk tolerance changes, they may need to adjust the allocation of their portfolio to better align with their goals. By developing a personalized investment plan, investors can have greater confidence in their investment decisions and be better equipped to achieve their financial goals over the long term. The eighth point of the book, Beyond Diversification, by Sebastien Page, is that investors should be mindful of their behavior and emotions when making investment decisions. The author argues that human behavior can often lead to poor investment decisions, such as buying high and selling low, chasing past performance, or being overly influenced by media and market noise. To combat these behavioral biases, the author suggests that investors establish clear investment goals and stick to a long-term investment plan that is based on a sound investment philosophy. Investors can also work with a financial advisor to help them stay on track and avoid making emotional investment decisions. The author also recommends that investors avoid reacting to short-term market movements and focus on their long-term investment goals. This can help investors avoid knee-jerk reactions to market volatility and stay invested through market ups and downs. By being mindful of their behavior and emotions when making investment decisions, investors can avoid common mistakes and stay on track to achieve their long-term financial goals. The ninth point of the book, Beyond Diversification, by Sebastien Page, is that investors should be aware of the impact of fees on their investment returns and look for ways to minimize their costs. Fees can have a significant impact on an investor's returns over time, and it is important for investors to understand the fees they are paying and how those fees impact their investment returns. To minimize fees, the author suggests that investors consider investing in low-cost index funds or exchange-traded funds, ETFs, that track broad market indexes. These funds typically have lower fees than actively managed mutual funds and can provide broad diversification across multiple asset classes. The author also recommends that investors compare the fees of different investment options and choose investments that offer competitive fees. Additionally, investors can consider negotiating fees with their financial advisors or investment managers to help lower their costs. By being aware of the impact of fees on their investment returns and taking steps to minimize their costs, investors can improve their long-term returns and keep more of their investment gains. The 10th and final point of the book, Beyond Diversification, by Sebastien Page, is that investors should stay informed and educated about the markets and their investments. The author argues that staying informed and educated about the markets and one's investments can help investors make better investment decisions and avoid common mistakes. To stay informed, the author suggests that investors regularly read financial news and publications, attend educational seminars or webinars, and consult with financial professionals when making investment decisions. Additionally, the author recommends that investors periodically review their investment plan and portfolio to ensure they are on track to meet their long-term financial goals. This can help investors identify potential problems or opportunities and make adjustments as necessary. By staying informed and educated about the markets and their investments, investors can make more informed investment decisions and be better positioned to achieve their long-term financial goals. Thank you for your interest in this book. I would much appreciate it if you leave your feedback on this book in the comments below, or just put a like on this video. You can find links in the description of this video, where you can purchase and download this book.